Hello aspirants and welcome again to Legacy IAS Academy. In this lecture, we are continuing with our detailed PYQ analysis for Indian economy. In this lecture, we will be looking at the financial market in India. Now, financial market in India is very important topic or chapter with respect to your prelims. In the last 10 years, around 16 questions have been asked from financial market. So let's get started with respect to the PYQs of this topic. So in 2016 is when this question was asked about the masala bonds. Now, what is masala bond? Basically, Indians or Indian corporates also borrow money from the foreign countries, right? So that is known as external commercial borrowing. So when we do this external commercial borrowing, we get the borrowing gets denominated into foreign currency. Now when it gets denominated into the foreign currency, there would be currency exchange rate risks that needs to be borne by our Indian borrowers. Now in order to ensure that no such risk is borne by our Indian borrowers, the government of India came up with the concept of, along with of course United Kingdom, World Bank, etc., in collaboration with these organizations and country, the government of India came up with the concept of masala bond. Now, masala bond is a bond through which Indian corporates can borrow money from the external market. That means they can get external commercial borrowing denominated in Indian rupees itself, as a result of which the currency exchange rate fluctuation is not going to impact the risk will not be borne by Indian borrowers. Rather, the risk is borne by the person or the company who is investing or giving the debt, right? So with that in mind, let us solve this question. With reference to IFC masala bond, sometimes seen in news, which of the statements given below are correct? Statement 1, the International Finance Corporation which offers these bonds is an arm of the World Bank. Yes, this IFC, International Financial Corporation, is one of the arm of the World Bank. World Bank has a total of 5 organizations together known as the World Bank Group. So it is an organization of World Bank. Number 2, they are the rupee denominated bonds, as I mentioned that they are, yes, and are a source of debt financing for the public and the private sector. Yes, for the public as well as the private sector. So both statements are correct. So the correct answer will be C, that is both 1 and 2. Let's move ahead. In 2018, another question. So there are certain years wherein multiple questions will be there, 2 or even 3, 4 questions would be there. Let's look at the question in 2018. Consider the following statements. The Reserve Bank, statement 1, the Reserve Bank of India manages and services Government of India securities, but not any state securities. Now this is incorrect. The RBI manages Government of India as well as the state government securities. So statement 1 is incorrect. That means this is gone and this is gone. Statement 2, treasury bills are issued by the Government of India and there are no treasury bills issued by the state governments. That is correct. 1 was wrong, but 2 is correct. The treasury bills are instruments of taking money from the market of the Government of India only and not that of the state governments. Hence statement 2 is right. Hence the correct option has to be C, that is 2 and 3. But let's look at the third statement as well. Treasury bills offer, this should be offer, treasury bills offered are issued at a discount from the par value. Yes, they are issued at discounts. Generally what happens is you take 10 rupees of loan and give 10% interest. So then when you are taking 10 rupees of loan, you are giving back 11 rupees. But here what happens, if the bond is of, let's say, 100 rupees, you are not given it at 100 rupees, you are given it at 97 rupees. When you return the bond, you get the entire 100 rupees back, as a result of which it is being given to you at a discount from the par value. So both, that is C, 2 and 3 are correct. Let's move ahead. Another question in 2019. Now, which of the following is issued by registered foreign portfolio investors to overseas investors who want to be a part of the Indian stock market? So in India, right, there are overseas investors who want to be a part of the Indian market. So which of the following is issued by the registered foreign portfolio investors to the overseas investors who want to be a part of the Indian stock market? Certificate of deposits? No, it is related to the banks. Commercial paper? Absolutely not. promissory note and participatory notes. Now here the confusion can come that whether it is promissory note or the participatory note. So the correct answer here is the participatory notes, that is also known as the PN notes. Now these are the notes that are issued by a foreign portfolio investors to the overseas foreign portfolio investors to the overseas investors for them to invest money in India. This is a really factual thing which is covered in your financial market static topics. Let's move ahead. Next question from 2020. With reference to the Indian economy, consider the following statements. Statement 1. Commercial paper is a short-term unsecured promissory note. Is it a short-term? Yes. See, this is basically a part of, you can say, money market. It is basically a part of the money market. At least if you know what are the instruments which are part of the money market, you can know that they will be for the short term only. So yes, this is for short term. So 1 is correct. When 1 is correct, this is gone. This is also gone. You're left with 2 options now. So you have to see whether 2 is correct or 3. 2. Certificate. 2 says that certificate of deposit is a long-term instrument issued by the Reserve Bank of India to the corporations. No, this is for interbank transaction, which I just told you that it is for the banks. So this is incorrect. When this is incorrect, this is also gone. The correct answer should be C, that is 1 and 3. But let's look at the other options as well. Call money. Yes, this is also a money market instrument. It's a short-term finance used for interbank transactions. That is correct. Zero coupon bonds are the interest bearing short-term bond issued by the scheduled commercial banks to corporates. No, they do not bear the interest. In fact, interest is paid at the end of the maturity period. So this is incorrect. The correct answer would be C, that is 1 and 3. Let's move ahead. This is in the year 2021. Now the question says that Indian government bond yields are influenced by which of the following, right? Now remember, in economy one particular thing can influence a lot, so it be very clear that to say that no, it will not influence at all. Even if it can influence a bit, it will influence. Very difficult to eliminate. Anyhow, let's see. Actions of the United States Federal Reserve. Yes, it's a connected, interconnected, globalized world, so yes, it will impact. Actions of the Reserve Bank, absolutely. Inflation and short-term interest, this should be inflation. Inflation and short-term interest, yes, absolutely. All of the statements here are correct. So the correct answer is D, 1, 2 and 3. Another question asked in 2021 itself. The question states that with reference to India, consider the following statements. Statement 1, retail investors through demat account can invest in retail investors as in investors who generally invest a small amount of money. Retail investors through demat account can invest in treasury bills and government of India debt bonds in primary market. Yes, they can. Retail investors can also invest. Statement 2, the negotiated dealing system order maintaining is a government securities trading platform of the Reserve Bank of India. This is factual. See, either you know it or you don't know it. It's quite difficult to guess it. But yes, 2 is also correct. So 1, 1, 2 are correct. This is gone. This is also gone. This is also gone. The only option left is B, 1 and 2. That means 3 will be incorrect. Let us have a look. The Central Depository Service Limited is jointly promoted by the Reserve Bank of India and the Bombay Stock Exchange. No, it is a let's say a collaboration of various certain banks coming together. SEBI and RBI are not involved as such. So 3 is incorrect. The correct answer is B, that is 1 and 2. Yes. Let's move ahead to the next, that is 2022. Now in 2022, I think 22, 23 and 24 there will be a lot of questions asked. Let us have a look. With reference to the Indian economy, what are the advantages of inflation index bonds? So your bonds will be indexed to inflation. Let's say for example CPI combined. Statement 1, government can reduce the coupon rates and on its borrowings by the way of IIBs. Yes. So when the IIBs are issued, they will be issued at CPI plus 0.5%, for example. That means you will get the interest rate over and above the CPI. Now if the government can manage to keep the CPI low, you will get very low amount of return. But the idea here is, as a person who has purchased that bond, you will at least get a bare minimum assured real return on the bond. So this is correct. So this is incorrect. Yes, other options still remain. Statement 2, IIBs provide protection to the investors from uncertainty regarding inflation. Yes, that is also correct. So this is gone and two options still remain. The interest received as well as capital gains on IIBs are not taxable. No, 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 they are taxable. Be very careful before saying that this particular thing is not taxable, right? So taxes are definitely there. So 3 is incorrect. So this is gone. So the correct answer is A, 1 and 2. Another question from 2022. Consider the following statements. Statement 1. In India, credit rating agencies are regulated by the Reserve Bank of India. No, that is incorrect. It is regulated by SEBI. It is regulated by SEBI. So first statement is incorrect. So this is gone, and this is gone. So the only option left is B, 2 and 3. But let's have a look at the other statements as well. Statement 2, the rating agency popularly known as ICR is a public limited company. Yes, it is. Brickwork Rating is an Indian credit rating agency. Yes, that is also correct. Let's move ahead. Another question in 2022 with reference to convertible bonds. Consider the following statements. Statement 1 says that as there is an option to exchange the bond. What are convertible bonds? See, convertible bonds or convertible debentures are simply the bonds and debentures which can be converted into equity. These are debt instruments, but it can be converted into equity. As there is an option to exchange the bond for equity, convertible bonds pay a lower rate of interest. Yes, if you are given some benefits, the interest would be lower. So 1 is correct. So this is gone. This is also gone. 2 options left. The option to convert to equity affords the bondholder a degree of indexation to rising consumer prices. Yes, it does, because instead of getting the money back, you can convert it into equity. Equity will generate you profit in the future also. So correct option here is C, that is both 1 and 2. Right. So we have seen 3 questions from 2022 itself. Let's move on to 2023. Consider the following markets: government bond market, call money market, treasury bill market, stock market. Now the question asks, how many of the above are included in the capital market? Such a straightforward, simple question this is. Now why this is simple is because it is not even asking you any parameters or any features of any market as such. It is simply asking if you know that which instruments are from the capital market. So government bond market is a capital market. Call money, remember previously it was included in one of the options. I said it is for the money market, so this is incorrect. Treasury bill market, again the money market, sorry, this is treasury bill is yes, treasury bill is also money market, so this is also incorrect. And stock market is the capital market, so this is correct. So the correct answer would be B, only 2 are the capital market is what they have asked, right? Yes. Let's move ahead. Another question from 2023. The question asks, in the context of finance, the term beta refers to what they are asking here. The process of simultaneous buying and selling of an asset from different platforms? No. An investment strategy of a portfolio manager to balance risk versus rewards? No, that is hedging basically. A type of systemic risk that arises where perfect hedging is not possible. No, a numeric value that measures the fluctuations of a stock to changes in the overall stock. That is the beta which we are talking about. So this is a factual thing, or a factual, you can say, a definition which you should remember. Let's move ahead. Another question asked from 2023. So as I said, in 22-23, the number of questions asked are too much. Not too much, of course, but quite good number of questions are being asked. Consider the following statements. Interest income from the deposits in InvITs distributed to their investors is exempted from tax. Again, they are saying exempted from tax. No, they are not exempted from tax. So this says both are correct. This is first statement is incorrect. Both are correct. No, because first statement is incorrect. Here statement 1 is incorrect. It says no, first statement is incorrect. So the only option left here is directly you get the answer, that is D. Statement 1 is incorrect, but statement 2 is correct. But let's have a look. InvITs are recognized as borrowers under the SARFAESI Act. Yes, that is 100% true. So the correct option here is actually 3. Let's move on to 2024. Now in 2024, I think around 4 questions was asked in this particular year. Let us have a look at that. Consider the following statements. If USA were to default on its debt, holders of US Treasury bonds will not be able to exercise their claims to receive the payment. Yes, that is correct. Now, statement 2, the US government debt is not backed by any hard asset. That is also correct, and that is the reason for this. Since it's not backed by any hard asset, they were going to lose it. So statement 1 is correct, and statement 2 is also correct, and in fact the statement 2 is the correct explanation also for statement 1. Let's move ahead. Another question in 2024. In India, which of the following can trade in corporate bonds? So they are asking who can trade in corporate bonds and government securities. Now basically, there is a huge pool of the entities who can trade. Can insurance companies? Yes. Pension funds? Yes. Retail investors? Yes. In fact, all of them can trade in the corporate bond and government securities. Let's move ahead. Again in 2024, consider the following: exchange traded fund ETF, number 2 motor vehicles, and number 3 currency swap. Which of the above are considered as the financial instruments? This is a financial instrument, this is a financial instrument. 1 and 3 are financial instruments. So this is gone, this is gone. What about 2? Motor vehicle is not a financial instrument. So 2 is incorrect. So the correct answer here should be D, that is 1 and 3. Next, again asked in 2024 itself. The question says, with reference to Indian economy, collateral borrowing and lending obligation are the instruments of. Now, here we need to understand that, see, since I am asking you this question under financial market, it is very easy to eliminate at least one option, right? So which option you can eliminate over here? You can easily eliminate the option which says foreign exchange, right? Because we are basically not doing the foreign exchange topic. But again, in UPSC, it will not basically be asked to you based on topic wise. So you will not know from which topic it is being asked. So anyhow, we have to still solve it. So with reference to the Indian economy, collateral borrowing and lending obligation are bond market? No, absolutely not. Foreign exchange also not. Stock market also not. It is the instrument of the money market there is. So collateral borrowing. Now what do you mean by collateral? Basically you mortgage a particular asset as a collateral against which you will get the loan, right? So it's a debt instrument, so wherein money is given. So when money is given as a debt instrument, of course it can be bond, stock also, but not stock, sorry, not stock, because stock is an equity market wherein you do have preference shares as well, but you have equity shares also. So you can eliminate this. Foreign exchange, it is not, it is talking about the debt market. It can be bond or stock market. And the lending obligations. So lending obligations or instruments with these kind of words you generally see with respect to the money market, not bond. Bond is about investment. It's also for long term. It is having a different connotation to it. However, guesswork only to a certain extent will work over here. The factual understanding should also be, or knowledge should also be there, that collateral borrowing and lending obligation are the instruments of the money market, that is option C, money market. I hope that is clear. So we have around 15 questions that were asked from financial market in the last 10 years. So around 1.5 question. In some years we have seen 2 or even 3 questions are asked. This becomes really important for your prelims, because in financial market there is money market and there is capital market, and under these there are various instruments in both of them. Who can issue what to whom at what interest rate or what rate or in what manner and for what period of time gives a lot of fodder to the UPSC for asking questions based on prelims to you. That is why, of course, means related questions can also be asked, but remember, financial market is quite an important topic for your prelims. So that's about it with respect to PYQs of the financial market. Please subscribe to Legacy IAS Academy and hit that bell icon so that you are notified every time we are live or we bring a video for you. Thank you.